Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest news around the housing market and why it seems New Zealanders still can't quite believe prices will fall. And we'll look at the latest news of stagflation and threatening the world's biggest economy and what that means for New Zealand interest rates and our exchange rate. But firstly, we had news out overnight that New Zealanders are less confident about rising house prices, but they actually think now is a better time to buy. This seems a strange result from ASB's Housing Confidence Survey for the 3 months to January. It's worth looking at the details. The proportion expecting higher prices has fallen considerably. It's now down at 28% from 36% in the last survey. The proportion expecting lower prices has increased to 28% from 24%. So the net result is that 1% expect higher prices. The expectations for interest rates are interesting too. 55% expect higher rates, while 8% expect rates to fall. That's actually more pessimistic than many economists, who reckon official interest rates are on hold for now. Although it's worth noting that wholesale interest rates, which are the ones that drive fixed mortgage rates, have been rising for the last 6 months. But the most interesting thing from this survey was the answers to the question about whether now was a good time to buy or sell. You'd expect that with more people expecting price falls and most people expecting higher interest rates, that there wouldn't be so many people who think now is a good time to buy. But instead, the survey found that more than a quarter of people think now is a good time to buy. That's actually up from 19% in the previous quarter. And the percentage who thought now was a bad time to buy actually fell to 27% from 37%. So here we have more people believing prices will fall, most people believing interest rates will rise, but more people believing now is a good time to buy. That implies the belief about house prices never falling too much over the long term is hard to break. My reading of this is that people see a little dip in prices and believe that creates an opportunity to buy before there's a turnaround and prices get back on their merry march higher. It's what I call the buy on the dips theory. Now that's fine if prices only dip, but if they drop like a stone, then you've just fallen for a sucker punch. Our belief at interest.co.nz is that the belief about house prices not really falling much is wrong. House prices are 30% overvalued and will likely fall that much in the next year or two. Now is definitely not a good time to buy. Now some news about the global economic outlook and what that means for interest rates and the exchange rate here. We have news in the last day that inflation remains a significant worry in the world's biggest economy, the United States, and in the world's fastest growing economy, China. The US annual inflation rate accelerated to 4.3% in January. This is despite more signs that the housing market is in deep recession there. US housing starts actually fell 3% in January to a 16-year low. And we heard from the US Federal Reserve in its minutes from its last meeting that it is very worried about slowing economic growth and believes rates need to be low or even lower for some time before things turn around. So despite its high inflation, the US Federal Reserve seems determined to cut official interest rates further yet. Most are now expecting the Fed will cut the official rate to 2.5% from 3% on March 18. When you look at it, that is a stunning situation. Inflation is 4.3%, and short-term interest rates will soon be cut to 2.5% in America. Yet here in New Zealand, the inflation rate is just over 3%, and our official interest rate is 8.25%. That's a pretty good real return here versus the United States. And that's one of the driving factors in our exchange rate approaching 7-month highs in the last couple of days, around 80 US cents. Signs that Asian economic growth driven by China is still strong will do much to keep our interest rates that high. China announced yesterday inflation was running at 7.1%, while GDP growth is over 11%. That's driving commodity prices higher. Both Asian inflation and commodity prices are being watched very closely by our Reserve Bank Governor, Alan Bullard. There's little sign yet of lower rates here. Life's not going to get any easier for home buyers and anyone with a mortgage anytime soon. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Friday.